Good morning, ladies and gentlemen. It's always a privilege to be the speaker after the coffee break. So everybody is full of caffeine and ready for the next session. I will try it because this motif of bridges being in this today's presentation. So I was thinking about doing another bridge over the theoretical waters that we just listened to and were introduced to us by our colleagues from Dagong Global on the rating environment and rating methodologies, and go a little bit back to our first two guest speakers from the Bank of China here in Frankfurt and the Milano Finanza, which I liked very much, because I love those comments from people that are hand-in and in the market, and that's why I focused in my presentation on the research that we have done on the Chinese foreign direct investments, and particularly focus on what was happening in Europe and with some comments on Germany. Let me see. Okay. I think that basically all of us know, and then if you read the main financial newspapers, basically every day there is something mentioning about China. But what we realized that actually also for us it was a little bit of having pieces of puzzle, and we didn't have the full picture. So we tried to put piece by piece, try to find the sources with the help of our colleagues in Beijing, and try to put a little bit more concise picture of what's happening in Chinese investments outside of China, and what were the developments, and try to build on that and come up with some drivers and factors that we think will impact those investments in the future. The agenda for today, I will quickly cover 6 main areas. In the beginning, 2 slides on facts that we all know, but just a refreshment and set up the base on China's growth and on the accumulation of the capital. Then the topic of what's on the agenda of the new political establishment of this decade for China, and that's kind of a newspaper's headline: China goes global. I will try to spot the main drivers behind that. Then I will stop a little bit on Europe and what role Europe plays in Chinese foreign investments and why. Then a little bit on Germany, and at the end we will try to see what our expectations and what we think the Chinese foreign investments will go to. So this is probably nothing new, and all of us know this. The China over the past 2 or 3 decades have grown significantly, have grown among the largest markets. Just few bullet points: 20 million passenger cars, the largest market in the world, 1.3 billion mobile subscriptions, and only 3 main companies servicing those 1.3 billion. 450 billion of US dollars in healthcare. We have read all the news in the past year about the pharma companies in China. 18 trillion of euro of assets in banking sector. And on the right side, a little bit on energy. China generates 22% of global electricity. 80% of that based on coal. So that goes also what our general manager mentioned in his opening remarks. The focus on the environment and green is connected to the fact that the energy sector in China is a little bit more focused on coal. As we see, the world's largest coal consumer and producer, second largest oil consumer, and the fourth largest oil producer. So the graphs shows I picked just the new car registrations and electricity production, but we could go for ages with those graphs where we see the red line going from decade ago somewhere on the bottom, with the 2013-14 being the number 1, number 2, or number 3. Connected to this is the development of the export. Of course, China over the past 2 decades became the production facility of the world. And through the export that grew from basically below 300 billion 15 years ago, all the way to the 2.3 trillion US dollars. Germany has been quite a one of the biggest trade partners, as our guests mentioned, and participated on this growth quite significantly. What the right chart shows is the effect of this export and the industrial growth that happened in China is the huge accumulation of foreign exchange reserves. And this has made the main shift that everybody talks about now, of the accumulation of the capital. So from the 20-30 years ago, where the most capital center was in the West, in the US or in Europe, the capital moved towards East and mainly to China. And those 3.8 trillion of US dollars in foreign exchange reserves are the main driver in this shift. Of course, China had to do something with this accumulated reserves. And there were different waves, and we could go for forever, for the whole afternoon discussing that. But very briefly, in the beginning, the main focus of the Chinese investments were on one side into the US dollar government securities, at that time perceived as a safe investment, or on the side of the direct investments, more in the area of natural resources, energy, where the China needed to support the industrial growth, needed to secure natural resources. Over the past 20 years, on the right-hand graph, we see that China grew among the top 3 foreign investors in the world. On purpose, we excluded Hong Kong. So if you see, the Hong Kong is actually 4th. So if we combine Hong Kong and China, which is not fully correct because some of the Chinese investments are going through Hong Kong to somewhere else. So that's why we keep it separately, because there is an overlap in between. And it's actually impossible to track down where is the balance. So, anyway, if we have the data, we think the Chinese investment would probably surpass the Japan and become the second largest. We didn't put Europe because we have separate countries here, but if we take Europe or European Union as a region more comparable to US and China, we would have Europe somewhere in between US and Japan, somewhere around 200 billion per year. Now, little bit to geographic split. It goes together with the focus of the Chinese investments that has developed over the past 5-10 years. On the right-hand side, we see the geographic split of Chinese investments in 2005. We have the Hong Kong, the other Asia, which is together around 60% at that time, Latin America being the 3 largest. The situation in 2013 is slightly different, and what we focus here on the fact that the 2 main changes in Latin America and Europe, we see that the Europe has grown quite significantly, considering that this is a stock of the investments. So that means it's not an annual, it's building up, so there is a historic track. And with that, Europe has moved from 2% to 8%. Of course, the investments in Asia, in Latin America, in Africa is going to stay there because China needs to continue to support their industrial base. Because with the exception of coal, China doesn't have many natural resources. So the investment into those are going to stay. It's not that they are going to disappear. But what we saw, the trend over the past 5 years, is clearly focusing or refocus on the Europe, and the reasons. And this is document that we have seen 10 years ago. The investments in Europe were relatively limited. They grew, especially around after the financial crisis. The little of a decrease in previous years, but in 2014, a significant shift, all the way almost up to 20 billion per year. The main drivers behind this development is the refocus of Chinese investments strategies, and it comes with the political agenda. It comes with the industrial need, and it comes with the overall situation that China grew into. Of course, we all read about China's growth. Is the 7 or 6% the right number? Is it not enough? Is it too much? I think the main topic actually is not about the single number. It's about the general. And now I'm going to divert a little bit to the academic world. If you look at growth, there are 3 main components of the growth. One being capital, the second labor, and the third productivity. So those 3, if you combine them, you give growth. In terms of China, if we apply this on China, capital, there is the biggest capital in the world in China. Labor, historically, that has been the main competitive advantage. That was the driver of the growth of China over the past 20 years or 30 years. In China, that there was probably the biggest migration in the history, where the 300 million people moved from western parts to the eastern part to support the industrial growth. Now, China, at the moment, this labor factor advantage is being more or less utilized. And so the remaining part to keep up the growth is the productivity. And how to increase the productivity and keep up the productivity is through technology, through know-how, through new technologies. And that's exactly connecting back to this actually slide before. That's why the Europe has started to playing much bigger role in Chinese investments outside of China. Because China needs at the moment, and everybody knows that, needs to increase the value added of their production. It's not anymore a competitive advantage to be a cheap producer. Because the labor factor has been more or less utilized, there are not that many people to be moved, and with all this, the multiplication effect is not working anymore. So the Chinese investments and all this strategy of China going global is not about China dominating the world. It's about helping themselves to keep the growth, to go abroad and find out the technology. Of course, there is a different approach. So where in the world to go for technology? Europe, US, Japan. Those are the 3 main technology centers. Relationship with Japan is quite difficult. US has been significantly restrictive. We saw that many Chinese investors have been pushed out of investments in the US. So Europe has become the target of Chinese investments, and actually Europe has been, and I think quite wisely, more accommodating to that. Because I think Europe started to understand, and there were actually two factors. Europe started to understand that the threat that we were considering historically, that the Chinese going to go acquire a company in Europe, take the technology, move it to China and start doing millions and tens of millions of copies. This is not anymore reality. Even Chinese realize that this doesn't go anywhere. Because you're copying, but after 2 years, your copy is obsolete again. So you would need to go again and buy the one who has the technology. So the Chinese now are much smarter, and the objective is much more complex in this respect, to actually find out how to become innovative, how to become more technology-driven on their own. And the investments in Europe now are more on a learning base. And that's why we think that's why the structure of the investments changed. That's why the new areas have arrived. And of course, as mentioned also by our speakers before, by our guest speakers, Europe is in a situation which gives also a second motif or incentive to Chinese investors. And that's the fact that we are going through a period of after crisis, low growth environment that in some cases might result in more price advantageous assets, especially on the southern part of Europe. And we saw the investments in Portuguese infrastructure, in Italy, in the electricity and sector and the gas sectors, and also in those countries the governments are a little bit more pushed into being more open because, of course, the financial situation of the sovereigns. From this shift that we realized, the 2014 results that I'm showing here are demonstrating quite nicely that we saw the energy, real estate, the agriculture is another area that's relatively surprising, but probably shouldn't be. The investments in food, agriculture, and also what we try to call a lifestyle areas have been on a strong increase over the past few years. In terms of country specific, historically UK has been the primary target. It's a little bit skewed by the financial sector because the investments were mainly in financial sectors. And the Chinese investors have made some large investments like Heathrow Airport, share like the acquisition of Thames Water, which is one of the largest water companies in Europe. But the countries that historically were not that targeted by Chinese investors started rising up the ladder. We saw Italy, which is a result of very strong investments in 2014 in the gas and electricity sector and in the engineering. The latest announcement on Pirelli is another example. And we saw the Netherlands, Portugal, and Germany also growing up the ranks here. Now this is just an illustration of the largest Chinese investments over the 2014. I think it nicely illustrates the shift of the focus of the Chinese investments, both in terms of geography and the industry. We saw the agriculture and food area coming up with the investment in Netherlands and the UK. We saw the real estate, but the real estate has changed a little bit. If we talk about real estate, we mean mainly the commercial real estate. Of course, the investments that are usually put in the press are relatively private investments into private commercial real estate. But what we realize that the trend is going towards the commercial real estate sector, like the Chiswick Industrial Park in the UK, the Louvre hotels, and other real estate areas. Of course, the energy sector, the automotive sector are the ones that gonna stay there. That was always the interest of Chinese, and I think especially for Germany, those I try to put the names of the main Chinese investments in Germany, and surprisingly, when I ran into one statistics where I wanted to use the graph, I saw the biggest investments in real estate. I was trying to find out what the Chinese bought in real estate in Germany. It didn't fit me. And then by going actually by name and doing further research, I realized that actually this source that I'm using here, that is actually a global M&A company that's producing this. They actually put the wrong classification. They put the companies like Putzmeister or Emtech into construction and through construction to real estate. So actually the graph that I'm showing here should have also a note that it's after Dagong Europe adjustments, because the real estate basically disappeared from the graph. And we see the biggest recipients of the Chinese investments in machinery, technology, and automotive. And that's also connects with what our guest speakers were saying. That's the main target of the Chinese investors that we see in the future will be in the smaller companies that have a strong technological advantages, have a strong know-how, and a high value-added products. As we saw if we go through the list, it's one after another. Companies that fit this definition. This is to just a little bit refresh. We try to put the logos in order to demonstrate the main areas where we think the Chinese investors in the coming decade will focus. On the left-hand side, there is the mainstream that used to be and we think will stay, is the utilities, infrastructure, energy. That's the evergreen for Chinese and investors, and we expect that to go and continue. But we don't expect any major increases in there. In terms of Europe, of course, probably all of us read a lot about the Silk Road, about the One Road, One Belt initiatives, about the Asian Investment Bank that China is setting up now. All those investments would go into the infrastructure, but primarily through the way from China to Europe. But if we look at the investments in Europe, we think it's going to be more of a stable mainstream in infrastructure. Where we already saw the strong trend is a technology, know-how, also a brand. What Chinese are missing is a strong brand. How many of us know any Chinese car producer? And they belong to the big ones, right? We probably know the Dongfeng because they acquired the Peugeot share in Peugeot. Maybe some of us know Geely because they bought the Volvo, but that's more or less it. And that's what the Chinese also are aspiring to do. Of course, building a brand for Pirelli, it took 160 years and a lot of effort, a lot of capital. So in a way to partner with those companies and invest in them, for Chinese, it's a little bit of a shortcut to get to this brand and get advantages from them and learn how to build those brands. So they don't repeat the same mistake as those companies over the 160 years were doing, and they can speed up their process of building up the world-class brands like we know, probably the most famous Huawei, that 10 years ago nobody knew about. Now it's with Siemens, Ericsson, probably the top 3 player in the world. So that's why we put the brand as one of the factors here as well. On the right side, that's something that we think will drive into the future. Food should be also agribusiness, and something that we like to call lifestyle, because you can put a lot of things under the lifestyle, including luxury, including health. We saw the acquisition of Fosun of Club Med in France. It's a bright example. And that goes again with another more demographic and social development in China, where of course the 20 years of building up the fortune, which was the main focus and main agenda over those years, to get rich, to get strong, now is shifting a little bit towards more soft areas, more lifestyle, more health, more travel. I think the Chinese tourists in Europe is going to surpass the Japanese, I think, this year. That's the expectation. I don't know if they did last year, but I think it was kind of a tie. I think this year it's going to be a clear win. So that these areas we think will drive the future investments. And to put the last but one slide here, this is to kind of to stress here that this is not just a temporary development. This is something that was put highly on the agenda in China, and of course China being a state-dominated country, whatever is put on the agenda officially then is actually over the time, sometimes over the longer time than we are used to, put in reality. And I intentionally put the note of or the quote of President Xi last year in the Asia-Pacific Economic Cooperation Summit in Beijing, where he said that the Chinese offshore investments will reach 1.25 trillion US dollars over the next decade. We tried to put it in a graphical form, and on the left-hand side, I don't know how you see it, if you see it well, the kind of pink part are the investments that China did over the past 2 decades, accumulated. So it's 660 billion. If this plan of investing 1.25 trillion out of China is going to happen, this stock of investment is going to triple, close to 2 trillion. So the red part represents the future investments of China in Europe, overseas. On the right-hand side, we try to estimate what impact it's going to have for Europe. The current stock of the investments is 53 billion US dollars. It's probably higher because this is 2013. The official 2014 results will be still published later this year. But that will be somewhere close to 70 billion probably. But the development, we see that for Europe actually might be even stronger than overall growth for the general FDIs. And with this, I would like to just summarize what I have presented here. The Chinese foreign investments are here to grow. It's on the political agenda. The China needs that because, as we see, the China needs to increase the productivity, needs to increase the know-how, the value added, technology, to retain its competitive advantages. Because the competitive advantage from the labor has been utilized already. The political establishment is clearly aware of that, putting it on high on their agenda. We mentioned the Silk Road, One Belt, One Road initiatives, AIIB. In terms of what implications for Europe, we see that the strong refocus from the resource-driven investments into regions like Latin America or Africa are going to divert more towards Europe. We intentionally didn't put here US because we, of course, cannot predict what the stance of the US officials will be towards the Chinese investments in the future. Might be that if the current relatively negative stance changes in the future, might be another bullet point will be added here with the US. With that, I would conclude on my presentation. I hope I didn't use too much time, and I don't know if the questions would be now or after Carl. No. Okay. So if there are any questions, I'm more than happy to answer.
Mic, are there any questions indeed? No. If that is not, Richard, I must have one question here, because of course we have excellently seen the long-term activity and investment stream from China into European target companies. That leads me actually to ask you on the way how you would do the credit analysis on a particular corporate, because I want to understand really what is it that the owners support, how does that get factored into a credit analysis, and what implications could that potentially have when you're in a management meeting with an issuer in Europe to really understand the credit risk that's inherent in that issuer?
Well, I think that that ties to more of what is the main drivers of the value proposition that with Dagong Europe here in Europe we have or we propose, is that our rating. Well, we are facing the situation where we are rating the European entities, but with the main goal to kind of build a bridge towards the Asian or Chinese investors. So basically we need to combine the analysis that respect that we are analyzing the European corporates, but on the other side we are focusing on the investors that have slightly different approaches and slightly different views. So that's why we try to combine those two and focus on the factors and drivers that would mix those two sometimes contradicting areas. Of course, the companies or the entities that are taking our rating have different motives. Two main of them, of course, with all those investments that we saw here, plus the portfolio investment that the large Chinese policy banks are doing, our rating could be kind of another value added when increasing the investor base. So expanding from current investors towards Asia, towards China. The second factor is, and we realized it's actually also quite important, and it goes back again what was said in the beginning about the cultural differences, that the issuer is using our rating not strictly for the financing or for the investment purposes, but also as a kind of a presentation tool. And that goes to the cultural differences. We had a bright example of a French insurance, credit insurance company, Euler Hermes, that clearly stated that our rating actually helped them to facilitate the negotiations with the Chinese Huawei telecom producer, and actually at the end secure a deal with this company for the whole Europe. So that's a kind of an indirect. And of course, all those factors need to be factored into our analysis. So that's why our analysis somehow differs from the other rating agencies, as you heard earlier today, and that's why our methodologies and our criteria were developed with a slightly different focus.